So in this video, right, what we're going to do is we're going to cover a few things. First of all is this seller stamp duty new and who will greatly be affected, and we're going to see who are the ones that majority of you may be risk-free from this, but some of you may be still needing this to help you in your property journey. So we're going to see, and also most importantly, how you can navigate all these noises out there, right, using our AI systems, our AI engine to look into the macro as well as the micro trends to do a comparative analysis. So let me guide you to see how you can also benefit from this seller stamp duty to your advantage later in the video. Okay, so one of the key things that I want to also stress that if let's say today you are wanting to go for the new launch ballots, right, then I think you may want to do some preparations. For example, when we are helping our clients to do things, we actually do quite a fair bit of prep before the information out there, especially circulating the prices. So we actually do quite a fair bit in terms of preparation for the balloting. Then of course, the actual day balloting flow is also very crucial for us to discuss together, and all the way until the selection of the units. So let us see what is happening in the stamp duty. Again, before you think that, wow, this is something drastic and big, actually this has already been done before. So back in the days when we already had our 16%, 12% and 8%, 4% previously. All right, so this was during the period of 2011. The government actually implemented this, and for a good 6-7 years, right, the rates for a 4 years holding period has been the norm, and after that, they actually reduced it to 3 years after 2017, and they revised it to 12, 8, and 4. So why the revise of now, if you look at it, is basically the same. So now we ran back to the same situation of 16, 12, 8, and 4 for 4 years. One of the key things that I also want to stress to share with you all is the seller stamp duty. Why is it here since 2013? It has such a big impact because seller stamp duty is really not to allow us to do flipping. Many of you who are unsure of what flipping is, it used to be before 2013, you can sell your property even 1 minute later to another person for an X amount of profits. All right, so that is in the past, and people have been using that as a form of growth mechanism, or they sell it 1 month later, 1 week later, 3 weeks later, anytime. So there's no duty on when you're able to sell your property. So that's the reason why there's a lot of speculation in the marketplace during that. We call it flipping every other time. So when the seller stamp duty was introduced in 2011 for 4 years, then it kind of curbed it a little bit. Later, we will study more into the data and numbers or the trends so that you all can see it specifically. Like, is this going to impact the price? Is this going to impact the volume? And most importantly is, how will this impact me? Very important. The key thing about flipping is now, because of this, everybody think that, oh, 3 years is considered flipping. So the history is actually, it's not 3 years now. 3 years to hold on to a property is actually a very reasonable period of time. If not, the government would not have exercised that during 2017, right? They reverted from 4 years to 3 years. But of course, if you ask me for a key thing today when we are looking at property is generally still a mid-term to long-term approach. Okay, you cannot just look at it as a short-term. And this is, I think, very worrying because sometimes we do get clients who come in and, you know, because of all the wow factor that everybody is selling, that, oh, today you buy a property, you can sell in 3 years and you make a profit, right? So I think this is very dangerous because we do have some clients whenever they are working out their numbers, it's like they die only can afford that 3 years of payment. And then they also tell us that, hey, Coach Edmund, die or this 3 years, or I must sell one. If not, I have no more money. I think this is a very dangerous way of looking at property. You are definitely speculating. Although we can say that there's not much speculative going on, but people still want to take the chance on push their luck a little bit. So I really don't encourage this kind of behavior since day one. We want to see who's more resilient, right? Who can last longer. So it all goes back to the foundation of how you look at property. Property, typically, you have to plan it in such a way that in the worst case scenario, okay, worst case scenario, your property, you can still sell, you can still sustain it, okay, you can still finance it. It shouldn't be that, wow, when the market comes down, then you have to sell your property. Right? I think that is something very dangerous to do. Okay, so I will not, okay, even if you want to do, I will not encourage you to do it. Please be mindful. Please be thinking that although property, yes, is a growth mechanism for many of us in Singapore, or should I say in Asia, there's still certain fundamentals and risks that we still need to undertake, or it's not a totally zero risk environment. We need to really play the sums right. We really need to study the relevant and current strategies that works. So I believe this seller stamp duty will not crash the market at all, based on the last adjustments that we had. The key thing is that today we also must understand that the speculative buyers are still in the marketplace. That means they buy already, wow, die in 3 years will sell. Then those who are really looking property as a more stabilized asset to increase your value, to increase your net worth, then you ask me, this is a good chance for all of us, because all the speculators will be out again, or not the yearly one now. Now we're talking about those who are playing this on a different field of 3 years. So previously, all the while when in my consult, right, I also have done certain guidelines for our clients, and I want to share with you, this is how we look at properties. There's always a different balance of how you want to enter into property. Alright, so if today you are intending to hold on to your property within 3 to 5 years, then you must also accept the fact that today your pricing in terms of a capital upside will be much higher. And your support for this 3 to 5 years, relatively, if let's say this property is very new and you're holding it for 3 to 5 years, then your support price will generally grow at a higher level. But of course, during this period, while you're waiting for the new property to be ready, you don't get your rental yield, and also there's no renovation cost involved. So while of course not everybody can go into this new launch market and just buy and then wait for 3 to 5 years without having a property to stay. So some of us, we will opt in, which is, if you ask me, also another level of safety, which is the 8 to 12 years mark. So the moment when you go into a property, that means when you enter, it's already a second-hand property, right? You need to acknowledge and accept that your pricing for your support is going to be average. The capital upside is going to be low. Why? Because first of all, you may be entering into this as a second owner or third owner, depending on which year, and a chunk of the profits could have already been used up in the beginning. So of course, when you are buying property like this, generally it's more of a resale, and your rental yield you will definitely still get, and whether you want to choose to renovate or not, it's really a different story. And if let's say today you're entering into stage 3, which I will advise you for those properties that is more than 15 years, be prepared to actually hold this property longer beyond the 10 years mark. Because if you are using an older property and then you hope that in the next 3 to 5 years you'll be able to exit, I believe your growth will be limited, right? That's why your support price is going to be weak. Your capital upside, because you are holding on to this property long enough, so there is enough runway for you to kind of ride on the different cycles of the market. So this is also fairly important. And of course, your rental you definitely will be getting, but if being an old property, you will have very high renovation costs also. So at every stage, right, 1, 2, 3, right, the key thing is that it's not about the type of property you're going to buy. So some people will say that, oh, just buy a young property or go buy an old property and then hold it for unblock and that kind of thing. So our theory when we are looking at properties in using our REI method, it's more on at which stage of your life do you need what type of property. If you're needing a property for your own family, for school, and then you went on to stage 1 kind of property, then perhaps there may be some misalignment. And this is what we see a lot in our clients' property situation, because a lot of them, what we realize is that they missed out, or should I say, they based on their criteria and selection based on the property itself, not based on their lifestyle, based on their needs, based on their age and everything. So we look things from a different perspective so that we can be more balanced in terms of foundation. So what is subsale? Subsale means, let's say if you buy a new property and the moment it crosses the TOP, okay, they have not reached 4th year, which is usually part where the CSC is done. So usually after TOP, a lot of people will start to rent it out, stay, or even sell it, because they have passed their seller's stamp duty of 3 years. So with this change to 4 years, which means that even if the property is ready in 3 years, you can't sell it, which means you will rent it out. And we will cover a little bit more on where, if today you are entering the property market right now, looking at this 4 years, what kind of property you should potentially look at if you are purely still looking at it from a growth perspective. Okay, we're going to study that. So the key thing is because of the spike of subsale, meaning before the property so-called ripe, like durian, not ripe already, I can sell it to the next buyer to wait for it to ripe again, in a very simple understanding. So I want to show you one of this data, right? Using our AI system and tool, right? We are able to kind of guide ourselves in. So let us just use this AI system that we have, right? And I want to plot out the entire Singapore trends, right? And all these are live data that we have. So I'm going to just put in every single properties in Singapore right now to see a trend between the number of units, the volume, and then from there, we can determine how are the subsale units going to be like. And is the volume really scary enough? That's why government came out this guideline, right? I think this is very important because first of all, before we even jump into any conclusion, we must understand what's the thought process behind government doing this, right? So we can actually see the entire trend, right? Of course, we only see so far. If we're talking about different cooling measures, more importantly is that you can see that our onward price trend has always been going up, okay, upwards. And these are all the volume, but this volume is based on what? It's based on just the entire market. Let's say we talk about from 2011, the entire volume of transactions in the entire area is 33,000. Okay, 33,000 volume. And of course, this is inclusive of private and condo. So we can actually look into this, and let's just look at condo for a start. Because why? Because I believe the guideline for seller stamp duty is really purely on our condominium level. So if you look at condominium, you can see that the numbers for volume is actually significantly different. This is actually condo numbers. It doesn't include the HDB. So we're talking about per year basis, right? Before the cooling measures in 2013, our per year volume of transactions is actually very high, more than 30,000 anytime easily. So that's why when 2013, when we came in with cooling measures, the numbers actually deplete quite a fair bit until 2021, where post-COVID hits. That's why it went up to 35,000. But let us just pull out the numbers. You can see that why we are seeing that today the prices are very different, because the numbers from 2011 to 2013, it actually went up to about 6% and then came down after cooling measures at about 10.82%. So from 2013 to 2017, it came down 10.82. So overall, from 2011 to 2017, it came down about 5.5% instead. Yeah, so this is important for us to understand that, hey, today it's not just about the prices coming down and we hope that this will happen, but based on trends, we believe that the prices will still be holding on, but we still need to be a little bit more careful to understand, okay, how can we do this better? So one of the key things that we must understand is, even in our advice to clients, we don't generally encourage selling a property in 3 years. Because 3 years timeline is really quite short. And to see one cycle for it to get a very comfortable growth, you do need time for that. And which is why every time when we are doing our advice on properties, it's usually from 3 to 5 years or even 6 years sometimes, depending on the situation of the clients or what kind of objective you're going for. So our role here using the REI method is, if you look at the typical cycle, 3 years is really too short. But there's a lot of hype going on. Oh, you buy already, you sell in 3 years, you pay your very reduced mortgage, and then you can just flip it. You know, that's the narrative we've been hearing for the past number of years. But sometimes I always believe, yes, right now is with 4 years. But 4 years, you also don't use it as a benchmark to say that, hey, I want to sell in 4 years, because I don't think it makes sense. I think what makes sense is you must ask yourself is, what are your plans after that 4 years? And that's when we come back to do review with our clients, right? Last time we always do it in the 3rd year mark. Okay, 3rd year mark means we come in, we reassess your property, we see your finances, and then we see, okay, what is happening to your property right now? Has it gone up? What's the potential of it holding on to this property or not? Then we will come out various scenarios and plans like, okay, is there a need for us to do anything about it? So at least for you as a homeowner, right, you get to know what is going on. Then you decide what you want to do forward. I always believe in planning ahead, not too last minute. So with this, it also gives us a quick overview about what is happening and what are some of the holding periods that you should be kind of experiencing in. One of the key other aspects that you also must ask yourself is that today, does the 3 year and the 4 year holding period make really such a big difference or not? Some narratives going on in the market is like, oh, now if I hold on to 4 years, it may not be as good because I cannot sell my property earlier and it will affect my growth. It will affect my growth of my property. So let me just give you some real examples. So because of our AI tool, right, we are able to kind of do quite a fair bit in terms of selections. And we are able to screen through the entire Singapore property to kind of shortlist very quickly in terms of their potentials, in terms of the rental. So let me just do a 2015 and to 2020 kind of benchmark, because I want to kind of see what are the properties that is holding this 5 years, and I want to do it before COVID, because a lot of people say, oh yeah, COVID one sure make money ma. So I want to do everything before 2020 TOP to see, is there really huge difference between 3 years and 4 years holding period in terms of your annual gain. So from here, right, it actually pulls out and you can see that it shows 358 resale projects with 6,854 listings. So we are able to pull out existingly how many units are selling at the moment. Of course, this is based on across the board from 1 bedroom all the way to 5 bedrooms. Different types, small development, big development, freehold, so everything combined together. As I mentioned, this is more of an exercise, so I just want to share with you some interesting findings. So I just want to randomly just maybe pull out some properties and to see, is there really a difference between 3-year and 4-year? And you can see that there's so many different properties types that we can choose from. Okay, let's look at High Park residences. And we can actually go into the details of this High Park to do an analysis of what it does. So for High Park residences, it TOP in 2019. Alright, 2019, this is of course in Fernville District 28 in the OCR area, 1,339 units. So I want to kind of filter it off based on their profitability. Okay, of course, this is across the board. That means this is across all the different types, 1 bedroom all the way to 5 bedroom, just to see what's their percentage like. So what I'll do is, first of all, I will filter it off based on their early dates, which is 2015. That's when the date of the purchase of the buyer. And when they sell, what's their holding period? We will scroll it all the way here to see our holding period. So we don't want to look at anything beyond 5 years mark. We just want to see, let's say, a 3-year and 4-year mark. Does it make any difference? So if let's say we go all the way down, you can see you have 6 years holding period, 7 years holding period, 8 years holding period, 9 years holding period, 5 years holding period, 6 years. You see? So this is where we will start tabulate based on holding period. So if you can see, if let's say it's talking about 3 years, 3 years they are hovering around maybe 6%, some of them 4%, depending on the dates that they started off. But the 4-year period is also about 4%. Some of them even 5%. So this also gives us an indication that actually for 3-year and 4-year mark, right, the differences is not going to be too much of a difference. Of course, it's ranging from 1 bedroom all the way to 4 bedroom type. So these are the differences. So let's just say that, okay, let's say I just randomly just select Urban Vista. Okay, very convenient to the MRT. And from here, let's take a look at the filter. All right, this is a 2016, so relatively young property. And if you take a look at their profitability, we can actually open up and let's just see let's view every transactions. And we start off with their 2013 year. So if you can see, they have ranging from 10 years, 9 years. So we just want to go down all the way to the younger years property. You can see the 3-year, 4-year, overall also about 4 to 5% range in terms of their profitability. So this also tells us that, hey, today is really the holding period that is going to make a huge difference. So if let's say I choose this Jet Residences, which I was doing some research recently. This was a 2017 property, freehold, reasonable size, 171 units. But if you look at the profitability right now, right, for the last 5 years, right, we just want to do a simple track and see how is it performing. So same thing, we will just filter it off to 2013, which is the start date of the purchase. And if we look at the holding period, let's just find the 4-year and 5-year mark. You can see their percentage of holding can be like less than 3%, even 2%. Or 0.07% kind at the bottom, right? If the holding period is not a key indicator, then why is it that even for properties like this, you're holding on to 7 years, 8 years, 9 years, their percentage is even quite lousy, less than 5%, less than 3% even sometimes, okay? And these are all annualized gains. So the question is, what happened? If year is not an issue, but we base on that and we don't dare to sell or buy a property, then why would Jet Residences underperforming so badly? The key thing is not about the holding period. It's always about the different criteria that you should be looking out to purchase a property. Okay, and I'll be sharing with you all what are the key criteria that we'll be looking at shortly. Because for us, we look at 5 criteria. If everybody just based on time to purchase property, right, then everybody part already in property. Right, but I don't think that is the right way to look into. So I think one of the key things is we must understand the mechanics of fundamentals for property, not only just about location, not just about size. There's other fundamentals that we should look at. Okay, a few key things that you all can write down to take note is you must always, first important thing is look at growth area. Okay, we're not saying that you should buy based on where you like, where you're familiar with. But if you're truly wanting to capitalize and optimize your potential for property, right, you want to look at growth locations. That's why I say that today, one of the key things is also to understand why government is doing seller stamp duty. So the sub-sale issue, and then of course the prices that's hitting up, there is certain control. But I believe government always plan ahead and they already anticipated certain things. That's why they rather do it first right now, although now we don't seem to feel anything. But I want to give you some key highlights of why I believe government is doing this because of some of all this information that is going on. 2025 master plan. And these are all hope. A lot of future planning, a lot of new things coming in, and this will always excite a lot of homeowners, a lot of investors, because we see into the future of Singapore and then we start planning it that way. Even when we are looking at properties to help our clients, we also based on certain master plan, certain concept plan, as well as blueprint of Singapore urban planning to plan for our clients. So there's so many things happening. Not only that, we are talking about second half, we're going to have so many new launches in the marketplace. This is the second half, and if you look at the prices, you'll be able to determine what is happening, right? So this is the entire 2025 second half supply, and of course there are still the unawarded sites that has not been confirmed yet. Right? They may be re-released or not, we do not know. But this gives us a good idea like why with so many land being launched, that means there will be an influx of buyers. And why would there be an influx of buyers? Then we must understand this one concept. Today, based on pricing, you have acknowledged that prices has been going upwards regardless of the market condition. That every other year, there's also certain crises happening. There's certain wars going on. There's certain situations, all right, whether it's different election, trade wars going on, and there were also our COVID situation. But overall, have we actually seen prices came down? So there's a big distinctive difference that you must understand between price and volume. Price does not mean volume comes down, price will come down. So that is a totally different decision-making process. But what contributes to buyers coming into the marketplace is definitely the interest rates. Okay, one of the key things, the government also are aware that, hey, now with interest rates coming down, it always fuels a lot of buyer sentiment to come back into the marketplace. Always. Okay, so this also allows the buyers, right, to kind of think twice now with this seller's stamp duty. But is it going to be a huge impact? I personally don't think so. Those who really want to buy, they will still buy it. But I just share with you from a buyer's perspective. Let's say today, the last couple of years, you wanted to enter the property market, but you're concerned because interest rate went up 4%. Then you say, better don't do anything. But now, what is happening for interest rate? Actually, interest rate has came down quite a fair bit because of US Fed rates, and they already stopped the adjustments there. So US side, they stopped their Fed rates from coming down. But what happened to Singapore? Actually, our rates have been dropping. Since January, 2.78, dropped to March, 2.38, then came down even more in May, 2.23. So even though US are not doing anything, but our Singapore rates keep coming down because we have changed our SORA trend, right? We have just changed our SORA trend. And this is also another factor why government wants to introduce certain preventive measures before things get out of hand again. Because when things get out of hand, who will complain? We are the one benefiting it, but we also complain. So that is why government rather, okay, let me do something first so that they can flush out all the speculators and not to come into the marketplace. And when this happens, right, can you imagine why would the government come in with a cooling measures to prevent prices from going up? Because they know price is going to go up. Does it make sense or not? They already are very confident prices will go up. So that's why they come in with preventive measures first. It will stop us from going in. So if today, because of that, you find that prices will come down, then are you actually losing out certain opportunity? Okay, so this is very real. And let me just share with you, right, what is the interest rate right now? So we track this every year, every day. So we have the HDB prices, but let's just look at the private prices. So you can see that our floating rate now is 2%, 2.3%. Okay, the last couple of months since May until now is about 2.3 something, 2.4 something, and then now it has dropped down to 2.3. The lowest being 1.98. And I'll tell you what's more interesting is our fixed rate. Lowest is at 2.1, 2.2%. You see, so with interest rates keep coming down without Fed rates cutting, and we are already adjusting ourselves based on this. What was your thought process? If today you realize overnight, hey, the interest rates actually come down already, will you also start thinking, actually, I should also enter into the property market? So these are all very real time that we are seeing. And right now, if as much as we're talking about, you can see that since the rates came down, so when rates came down, right, so this the green color one is our SORA rates. You can see that when our SORA rates is low, prices start to climb up. Interest rates are low, prices start to come up. But the fact is, even with our interest rate high, our prices are still going up. So the government also realized that there may be a certain reattachment of interest rates as well as the prices and the sentiment of the buyers in Singapore. Because typically we are quite well versed or in investing, we know where to move our money to, we know where to park our money, and property has been one of the safest assets. That's the reason why we are seeing a lot of liquidity in the marketplace. We are not experiencing what happened before 2013 anymore. And these are the few reasons why I see today, based on the market, based on this SSD, is a preventive measures to really flush out all the speculators. And I believe this period is going to be interesting, but we still need to be extra careful not to anyhow just jump into the marketplace. And interest rate is not the only key thing. Have you ever asked yourself what will happen if let's say government really remove this 15-month wait-out period? Okay, so this is also another very important element that I find it will also create quite a fair bit of differences. For 15 months, would it flood in another group of buyers in the marketplace or not? Definitely will. If they remove, that means after they sell the condo, they can immediately buy HDBs. So there's a lot of implication for both HDB and private. Although, if you are upgraded from HDB to private, even with this 4 years, I don't believe there's much of a difference. Actually, it's a discount for you because you don't need to wait for 5 years. You just need to wait for 4 years. You are able to actually benefit from upgrading to a private property. So again, I also want to stress that it's not really whether you should be entering into the market or not because of this 3 years to 4 years. I think more importantly, look on holistically, what is your future plans going to be like in the midterm? You are talking about 3 to 6 years period. Are there going to be major changes in terms of your lifestyle, in terms of your income, in terms of how you look at your investments? Then from there, we can work backwards to see how we can plan for you. So most importantly is today, if let's say you are looking for new launches, then you say, oh, I cannot sell in 3 years, then you can continue to rent. So let's say, for example, you are buying a new launch, then you just have to rent it out for 1 year. Also, that's why this is also one of the criteria that we have in our selection process. So if you're going for resale, then of course, I will not really suggest you to just sell in 4 years or so. Because usually for resale, you may want to really just hold it a little bit longer. And generally, you're buying a resale is really for own stay. Or nobody buy a resale and then they say that they want to sell it for profit. Unless, okay, very rare situation, which is COVID period. Or you manage to buy a resale and then overnight, your prices went up. Then you may have the thought of selling. So this is also the key part that a lot of homeowners, I believe, who are in this sub-sale category, right? Not everybody is flippers, but because of this period where the entire property prices went up. So if you are a homeowner and you start seeing that, hey, your property has over the 4 years, 3 years period went up to 300 to even 600 or even $1 million in terms of a property gain, will you be tempted to also sell it within the 3 years period or just after the 3 years you sell them? So these are what they categorize as sub-sale, right? It's a repercussion because of our lack of supply during COVID period, and that's what constitutes to the high value. The prices increase, and any homeowners, when they see that their prices reach a certain level that they have never seen before, of course they will want to sell it away to unlock profits. Yeah, so it's a chicken and egg situation that I see, but I believe this adjustment for 4 years is really to prevent things from to come, and that will also constitute to how the future units are going to be like. Because with these 4 years, right, that means we're talking about lesser units in the supply situations. Today, you buy a property in 2025, and then you can only sell in 4 years, which is 2028 or 2029. So right now, we already know that the supply in the marketplace in 2027 to 2028 is about 6,000 plus per year. But of course, this will be adjusted from this second half of the supply coming in. But it will not go back to like very high supply period where 15,000 per year. And we are seeing that supply is coming down. And let me ask every one of you here, if a supply situation is coming down and over next couple of years, we know that supply is coming down, what will happen to price? Okay, when a low supply environment, price will go up. And with this plus 4 years situation happening, right, which means that even during the 2028 onwards, right, we are definitely going to see not enough supply because they can't sell. If you can, you will not want to sell and absorb the 4% stamp duty, right? So which means that today we are already foreseeing what is going to happen in the next 4 years where there's not going to be enough supply. And based on the numbers and based on the data that we have collected, the supply is only going to be depleting because not everybody by the 4th year, they will also sell their property. So that's why we are definitely going to be in a supply crunch, right, moving forward from 2028 onwards. And when that time comes, then you need to ask yourself, when should you be entering into the property market to capture the advantage of this supply situation? All right, so this one is what we do with our consultations, our private clients, to guide them through how they should enter the market and how they should exit the market very easily. So in time to come, I will believe that there's a lot of changes So some of you may be asking, so if I want to enter into the property market, what are the few things that I should take note of? I believe that today, if you are entering the market, you want to have additional safety net. Okay, what do you mean by additional safety net? Is that today, like for example, when we are guiding our clients in, right, we always have this understanding is today, if you are just buying and you're speculating in the market that, oh, today I buy this property, likely I will be able to grow my property profits, then you are guessing, you're speculating. Because everything that we want to do is we want to plan ahead. We have 5 strict criteria, right? The 5th criteria that we're using all the while, right, actually is very relevant in today's market. So what is this 5th point that you must have in your property? Is your rentability, which a lot of homeowners, they tend not to see it. Why do we even consider this many years ago when we created our REI method? Because today we need to always plan about the worst case scenario. In the event, if your property, you want to stay, you decided not to stay, you want to sell, but the market may not be at favor, at least you can still rent it out at a comfortable rate. And we are talking about looking at high rental yield environment. These are all key things that we look at, that worst case, hey, I can still rent it now. So that's why it becomes one of our factor whenever we look into the selection. And we have this 5 strict criteria is very strict. It means we don't even enter the market if any of these 5 don't work. Okay, that's how we position ourselves. That's how we guide you through the process. And this is more important to look into it. So let me just give you a very quick understanding, right? How does this work? Okay, let me show you how does this work. So let's say today we are looking at properties, and I want to kind of derive, let's just use back the same example, right? And I want to see that, okay, maybe I want to look at properties that I want it maybe less than 10 years. So first of all, you can choose the districts, but let's just use everywhere in Singapore just to have a benchmark. And I want it relatively near to MRT. Let's say, okay, these are some of your personal criteria. Oh, I want it MRT. Maybe 1 km is too much. I want 500 meters. And then you hear people say that, oh, school also is important. And okay, I want 1 km to school. Or a tenure, maybe you're not so concerned. But if let's say today you're looking for a 3-bedroom height, and we can actually use this as a guide to help you filter this AI engine to help you. And typically, I don't encourage anything less than 100 units. And let's say we're talking about TOP, relatively young property, let's not go too old. So now it's 2025. So let's say we talk about maybe about 10 years. So we talk about, let's say minimum 2015 type of property. Or size-wise, I mean, like I said, this demonstration, we just want to see. But of course, you also have a certain price point in mind. Or let's say you're talking about, let's say 2.5 million property. I don't know whether have or not, but let's just see. Okay, let's remove the new property. Let's just say that we want to go in because we want to have a security of rental, let's say. So with this, right, we'll be able to actually determine these are the number of 76 resale projects that has this kind of potential for the rental capability. So this is the first level of filter that we do. Then the second filter that we do is we come back to our pro trend. So let's say I want to pull out a certain comparison. So again, we'll put in the same illustration, and then we put in near the school. So number of units, again, 100. And then we will look at TOP, 21, okay, minimum. The rest, we put it the same. Our maximum amount is 2.5 million, and I want a 3-bedroom. So we put in the same parameters. When we use ProMax, it's just to give us an idea, okay, are there any properties around the area? But I want to be more specific. Then I'll be able to click in this yield. Let's say I'm looking at, let's say minimum, I want 4%. Okay, 4.5%. Let's see. That means out in Singapore, right, if I have 2.5 million price point, right, can I find a 4.5% yield that is relatively young property for a 3-bedroom? I also don't know whether I have or not. But this will be kind of the research that we can help you to shortlist properties in a quicker way. So that means this kind of results we need to do some adjustments. So let's say we say, okay, maybe 2010, and then we talk about, let's say 3% example. You can start getting new results. And this also gives us a more reality check that whatever that you're looking at, does it really have in the marketplace? And if you look at it, we have everything from different locations, different districts. We can even go to the specific projects to understand, okay, which is the unit type that we should go for very specifically. But one more importantly is that if you look at here, these are all within 1 km. Our 500 meters to MRT, they're all 1 km to schools. And you can see that their rental yield for the past 12 months, average yield is how much. So this becomes a blueprint for you to work with us hand in hand to kind of select the kind of property that you want to go for moving forward. And with this 4 years SSD situations, I think this becomes a very important point to not just only look at how much I can buy, what is the location I want to buy. You really want to also start looking at in the event after your property is ready and you potentially need to rent it out in for 1.5 years or even 2 years sometimes, will the project in that area be able to help you sustain a good rental returns or not? Okay, not so much about the profits, but can it sustain part of your mortgage and interest? So all these are the numbers and the financial sums that you need to really work on instead of just anyhow tikam lah. So that's why whenever I share about some of all this using research and data, right, it gives you as a homeowner more confidence about where the direction is. And even though you may say that, oh, this is what I want in terms of option A, our role is to provide you, is there another perspective that you have not seen it before? Then we can show you the option B or maybe even option C. Then we can plan and see how it goes. Especially with this SSD, you want to properly calibrate your plans and navigate properly and see how your property can sustain. So with that, I really hope that you all have more insights regarding the property market in Singapore. And also don't forget that today, if let's say you want to seek a second opinion, you really want to dive in using our AI engine to help you to kind of pinpoint certain projects that you wanted to look for, but you don't know whether is it good enough. Let us look at different parameters and perhaps it can help you make a better logical decision and you don't need to second guess yourself anymore in the marketplace. So with that, don't forget to also like and subscribe to this channel and follow us through as we empower you with more educational content in the entire Singapore market. All right, with that, thank you. Cheers.